Hi, welcome to the Market Alert for Friday, the 4th of March 2016. So yesterday, very quiet in the first part of the session. I did send a note out to say why it is quiet. Two reasons. One, they want to get the implied volatility down in the VIX to much lower lows so that they can ramp up the price of the put options when they have the next downside move. This has always happened ever since I started trading. Uncovered this back in 1994. Articles were written in different trading magazines about it at the time, and it's never failed yet on both the up and down. The only problem is you can't pinpoint the date, but it does give you advance warning that the current move that we see when we look at the daily chart is starting to look a bit tired, and that of course is given away by looking at the implied volatility, which we'll come to. So the first trade down at the market reverse gave us a loss, and then we had to wait for the manufacturing figures. And in fact, if you have a look at these figures, you can see that the ISM non-manufacturing came out just slightly higher at 0.2, but just have a look at the factory orders, 1.6 from a forecast of 2.1 and a previous of nearly 3%, so halved. Also notice that every other figure is also in red as well. This market, the US economy, is on a downward spiral to a recession once more. We know it is because you can't keep pumping money into the market and trying to keep things alive, and now the chickens are coming home to roost. So then we had we had a 20-point rise after, and then we had the minor celebrity banker Andy Haldane speaking at 5:45. This gave us a chance to take the buy side because we know they always use the rhetoric to pump the market to the upside. It's very rare. 9 times out of 10 the market will go up, and that's precisely what happened. So another 20 points pullback there just to finish off, really break even. And by the time the market had traded for the first half an hour or so, I'd got bored and given up. That's because today we've got I'll just move to the daily chart. That's because today we've got the non-farm payroll figures out. These are crucial. This is the second highest rated high impact news item next to an FOMC announcement. So the Fed will be looking closely at this just to see if Yellen's so-called strong labour market, the reason she put interest rates up, is still intact. So that's why the market was quiet during yesterday. One of the reasons, I say, along with the implied volatility. If you keep the market quiet, the implied volatility drops, and mission accomplished, as it were. So non-farm payrolls out at 130. So keep your eyes on this one. They're forecasting 195,000 increase in jobs. So that's a big ask from the previous of 151,000, especially given that there's the only jobs that are really being created in the US are service sector ones. So let's wait and see. But in the daily chart, you can see the market struggling with the 16,000 at 969. In fact, the 17,000 is what it's actually struggling with. So let's see how the market gets on today. And the upside there, 76%. I'm hoping the figures are going to be good and they will drive the market higher. I want to see prices move higher, the implied volatility move down to that 10% area, because that would be far better than to actually move lower today. The higher this goes, the lower the implied volatility figures goes, the better. And the reason for that is quite simple. Let me just remove the news there. If we just do this, we know we've got a very weak stock market now. And if we just go all the way back to May of last year, where the market started to fall, which is just off here, you can see the market's attempted to come back and then gone back down to retest more or less the August lows. And now we're seeing a retracement in this area as well. So if we can get back up to these levels, I will be absolutely thrilled, because it's a case of being able to tuck underneath the rising lows that the market's making. And what I mean by the rising lows are these higher lows as the market's going up. And then we can tuck underneath these in the daily chart by 50% and then hold this position back to the downside as well. So more of a longer term trade than just in a 5-minute chart. So the higher this goes, the better. So fingers crossed those no doubt manipulated non-farm pay figures will be enough to move the market to the upside. If it goes down, well, that's just too bad. But that's what I would be hoping for today. Talking of implied volatility, this down now below the 14.96. This is fantastic. We've come all the way back now over 10 points or 10 percentage points from 25 down to 15, below 15 now. So that's a really good pullback, and we could do with it going back down to these lows before we then get these big spikes as the underlying market then falls out of bed. Right, though, that's it really for today. I could go through a few news items, but really there's not a lot else to say, because obviously the market is focused on the non-farm pay figures to be released a little bit later. Right, that's it from me. I will see you in Monday's edition if I don't communicate via email later on today. Other than that, have a great weekend. Fingers crossed the figures are good. The market goes up. That's what we want. And I'll see you in the next one. Thanks for watching.